Hello, everyone. Today on the Final Bar, we have a guest, Mark Newton from Newton Advisors, going to help us make sense of this sort of bear market rally phase that we're in. Does this have legs? We continue further on to 2,800, or do we continue the bottoming process, pull back? We'll try to get behind that from a top-down and bottom-up process. Also, we're going to answer some of your questions from the Final Bar Mailbag. Had some great questions about behavioral biases, about some technical indicators, some new chart types. A lot of good stuff to break down. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to today's show, The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close. Break down the markets from a technical perspective, try to connect today's short-term fluctuations with the longer-term trends, help us be on the right side of things that we need to. Happy end to the first quarter. I don't know if happy is the adjective I would use, but end of the first quarter it is. And, today we had today I feel like encapsulates the experience of this quarter. We started up with a sell-off right out of the open. We rallied out, and so lunchtime we were in the positive, and then through the rest of the day we sort of trip on ourselves, and by the close we're back down about 1.6% for the S&P. So that sort of movement, I feel like, is how this market has been. It's indecisive in some ways, especially out of the rally. We've sort of been chopping around. So we're going to try to hit that from a number of different ways, answering your questions, but also with a really good guest, Mark Newton, who's joining us in a little bit. A lot of great tools on StockCharts TV to help you navigate this period. I did want to point out tomorrow on April 1st, this is not an April Fool's joke, but actually happening. We have a new special called The Pitch, where 3 of our StockCharts contributors are going to come on, pitch 5 stocks apiece. I'm going to attempt to moderate this discussion and help us think about positioning in this coronavirus area. What stocks look interesting at this point? Also, my guests later this week on the show here, Ari Wald and then JC O'Hara. And then next week, we have Harry Boxer on the 7th, and on the 8th, Jesse Felder. Also, I wanted to point out this weekend, coming up this Thursday, Friday, the 2nd and 3rd, there's a special event called Tech Wizards 2020 that I'll be participating in. I'll be speaking, doing a conference, a presentation on relative strength, how to think about it, how to screen for it, how to use it as part of your trading approach. So maybe an interesting session for you to call in on. And I know Mark Chaikin and some others are going to be participating as well. There's instructions on the screen on how to sign up for that if you're interested. And we'll hope to see you participate in that virtual event. Okay, so getting to our market recap today, the S&P pulling back a little bit, as I mentioned in the introduction. I feel like today was a great way to wrap up this first quarter, because the movement today sort of encapsulated the experience of this first quarter. Sold off a little bit, then this nice rally sort of going to above yesterday's close. We're in the green, felt pretty positive. Midday after lunch, we start selling off, going below the open, and then just sort of chipping away lower. And at the end of the day, we have this nice sort of bearish bias to it. And I feel like that bearish market phase with little glimmers of hope is the way that I might summarize the overall market environment here at the S&P. It's a rally of hope, not a rally of substance, unfortunately. Today's sell-off pushed the S&P down about 1.6% to close just below 2585. Mid caps and then small caps, down a little less. With small caps actually almost flat for the day, just a rounding error below 0. So certainly it was the biggest names and mega cap names leading the way lower. The VIX down a little bit today, just around 5350. And again, these, even though the VIX is up or down, we're still range-wise very elevated from where we've been for a long period of time. So make no mistake, we're still at a very elevated period of volatility here. Let's look at some non-equity asset classes just very briefly. I thought it was interesting to see that the TLT bond prices actually rallied. So as stocks started to roll over and go down into the red, you actually saw bonds emerge. And I thought we were starting to get this divergence of weaker stocks, stronger bonds. That actually resolved with everything going lower into the close. Pretty much most assets down, even the dollar. So bonds actually down 0.8%. That pushes the 10-year yield up around 70 basis points total. Commodities, again, broadly speaking, down. Copper was the only ETF that was up today. Gold was down about 3%. The chart of gold is getting less positive, I feel like, by the day. And today was certainly more of a distribution. Overall, we're sort of in this range-bound move on the GLD between 136 and 159. But again, today sort of breaking down back below the 50-day moving average. It feels a lot like it did back here, sort of that second week in March, before we had a bit deeper of a sell-off. So, I can't guarantee that's what's going to happen, but that was interesting to see gold actually sort of consistently down through the course of the day while other assets were fluctuating. The oil prices in the form of the USO, the most liquid oil ETF, down about 0.5%. When you look at sectors, you'll see energy was actually one of the few that was positive. It's actually the only 11 of the 11 S&P sectors finishing in the green today, up 1.5%. Next was communication services, down 0.2%. Then healthcare down almost 0.5%. Energy is a tough one in our segment sector setups yesterday. And if you missed it, go to our YouTube channel. You can see that breakdown of sector rotation in some of the individual sector charts. From a trend following perspective, I think it's really hard to justify energy here by any stretch, because it's just been a chronic underperformer, very beaten down. And again, the technical thinking is that when price is down, it's down for a reason. However, I think I could see the value of it if you're thinking longer term, if you're thinking of valuations, if you're looking at dividend yield in a company like Chevron, if you expect that they'll be able to keep up with a decent dividend, all of a sudden the yields you're getting there are very compelling relative to any other yield you're going to get in the market right now. So, again, a bit of a rally here, but everything else sort of on the weaker side. At the bottom, you have that traditional defense. We have utilities, we have real estate, and then financials. So REITs and UTs sort of are the two defensive groups that at times have been real leadership. I'll be interesting my guest Mark Newton in a little bit. I know I was going to talk about utilities a little bit, so we'll see how that fits into his methodology compared to some of the other groups like tech and financials. Just looking at some of the other universes we tend to break down, looking at ETFs, you have a number of them that are actually positive for the day. So Canada up the most, over 3%, followed by Mexico and Russia. So it's interesting, even though oil prices fluctuating, some of those markets doing okay. And then on the downside, you have Japan leading the way down almost 3% on the day, followed by Brazil, and then the S&P third from the bottom. Looking at industry groups, and again, always remember with these groups that we're looking here at the bottom, remember this is 1 day's trading. So yeah, I would hesitate to draw deep long-term conclusions. Think of how this fits into the big picture, and always look at the charts to make sense of it. Within materials, you had non-ferrous metals being the #1 group. Again, these are coming out of some pretty decent beaten down levels, but putting in a bit of a higher low, which is kind of which is compelling. I think it's one of the ways you measure things that are going to survive and be resilient of a sort in this sort of environment. It's things are able to establish a good higher low. Potentially a group there within materials is able to do so. After that, you have some of the energy groups like pipelines that have done pretty well today. Also E&P stocks in the top 10. Down below in the top 10 groups, you have things like travel and tourism, tobacco, automobiles, and the tobacco stocks in particular. Boy, they're interesting, and I think on a relative basis they've led out of the lows. So as you look here, bottoming out third week in March, and then we see this nice rally into where we're at today. So even though they were testing a new relative low for the year, they turn around and now approaching relative highs for the year, which is compelling. So, impressively coming out of those lows. When we did our dividend screen not too long ago, we talked in particular about Altria. I want to say Philip Morris. I forget which one of those names hit that dividend screen we were looking at, but some of them again compelling with compelling yield arguments. In terms of groups down, you have some of the REIT groups, real estate, also utilities with water and multi-utilities. Down there at the bottom, but you have a mishmash of other things as well. Things like clothing, home constructions. This is the home builder group. So a number of, it's really a diversification of sorts, really a spread between some of the worst performing groups and the top performing groups, sort of top to bottom there. We mentioned yesterday in our segment on stocks, looking in particular on some of the leadership names. So again, I'd remind you to look at some of the stocks at the top of the scooter rankings. Again, coming up tomorrow, we have a special segment called The Pitch, where we're going to have some of our StockCharts contributors sharing some of the charts that they are finding most compelling right about now. But I did want to finish up just looking at the Mindful Investor Live chart list, and in particular, look at this this breadth picture here. So this is looking at the breadth by cap tiers. As I mentioned before, I think what's really compelling as you try to navigate this bear market period is looking at measures of breadth and looking at whether breadth is able to improve. And this is one of the ways that I am looking at the ability of the average stock, or sort of the overall collective groups of names, to start to perform well. And I'd want to see material improvement in this breadth picture. We're just arguably starting to see it, but I'm not seeing the follow through quite yet. A higher low, especially here on the S&P. That's where you had the strongest breadth going into the market peak in February. I'd certainly want to see an improvement there. Not quite there, but just starting to turn up a little bit. That's why it's sort of on my radar. That's our market recap for today. Again, some interesting moves, and again, right at this period, I think we're at a key potential turning point. Having said that, let's answer some of your questions from the Final Bar Mailbag. Love to keep the show interactive. Please keep your questions coming via email. We'd love to answer them. We want to start with a poll. We actually asked you on StockCharts TV, on the window on the right side, there's always a poll going. I'd encourage you to answer those as much as you can. The question we asked recently: do you expect to make changes to the investments in your retirement account sometime in the next 30 days? 50% of you said yes, 30% of you said no, 20% undecided. I thought it was interesting to see in the last couple of days, about half of you saying you're interested in making or you're expecting to make changes in your retirement account in the next 30 days. So again, I think, the question when you're dealing with this environment, I think the number one question you want to ask is, how long is your runway? And if you were trying to time this thing in the short term, number one, I would say calling bear market bottoms as they happen is incredibly difficult. And I've seen people try to do it, and will continue to try to do it until I am well past my investable days. And it is in some ways, most difficult thing you can try to do is time that bottom as it's happening. But if your runway is long enough and you have the ability to buy in after the market is down 20, 30, 40%, overall, the one thing that has absolutely 100% been true up until now is every bear market phase has been followed by a bull market phase. And if your runway is long enough, I think it's a decent opportunity to bet on some long-term improvement overall. Years from now, I'm fairly certain that stock prices will be higher than they are right now. The question is, between here and there, what sort of downside are you comfortable with? What sort of volatility can you deal with? So the question I would answer before I would answer that poll question is, how long is my runway? And in a retirement account, if you have a long enough runway ahead of you, it could be could be a compelling option. Let's get to some of your other questions, and I'm going to go quickly through 1, 2, 3, 4. Boy, I picked 5 of them. I promise, Mrs. Keller, I'll try to limit it, so I'll go as quick as I can. Question number 1 was on Heikin-Ashi candles. This is a bit esoteric, but the question was, can you scan for it? What are the advantages and disadvantages of the Heikin-Ashi technique? So I will give you the quick version, and I will qualify that by saying I'm making a note to record a longer video, really digging into this in a little more detail that might be a little more helpful for you. This is a chart of Microsoft for the last year or so, and this is a traditional candlestick analysis, right? It comes from Japan from centuries ago, and this is the way that rice traders started to measure the movements in their little market. So it tells you the open, high, low, close, and it's very visual. You have the clear candles telling you up closes, the solid candles telling you down closes. I'm now switching and showing you the same chart of Microsoft, but using the Heikin-Ashi technique. So here is traditional candles, number 1. There's the Heikin-Ashi, number 2. So as you can see, it kind of looks a lot like a candle chart, and you're right. But what it basically does is it's a candle chart, but it smooths out a lot of the noise. So uptrends will be a consistent stream of up candles. Down moves will be a consistent stream of solid down candles. The way that they're calculated is a little outside of what we can do, but if you go to our Chart School article on Heikin-Ashi, you'll get the full explanation of how it's calculated. It basically uses an average of open, high, low, close to give you the close of the candle. It uses averages to give you highs and lows and opens as well. As a result, it's a way of illustrating the trend. The reason why it's interesting on this chart of Microsoft right now is because it tells you for the last 7 trading days, it illustrates the strength coming out of the lows. On the traditional candlestick chart, you have the up bars and down bars. And even though you can see these long white up days, you also have these little black down days that could kind of make you a little nervous. The Heikin-Ashi is meant to smooth that out, so you can see an uptrend usually is filled with some solid up candles. So in this environment, looking for a down bar on the Heikin-Ashi system can be very, very helpful. The short answer is no, we cannot screen on those. Could be a really interesting thing that I jotted down for our developers, but that's the basic way you use the technique. It's candlesticks, but with less volatility, less noise. Question number 2, wondering if Friday's close, the last hour sell-off may have been institutions' end of quarter close. So absolutely right. So we're getting to, today ended the first quarter. At the end of the quarter, you usually have the window dressing, you have changes in positioning. What's interesting with this time, though, is there's been a lot of discussion that pension funds and big buy-side institutions that would normally use that period are actually been giving a little more flexibility right now in terms of how they actually change positions. So the idea is the market's down a lot. If a big fund wants to rebalance and make sure they have enough of an equity exposure, they would need to buy enough equities to increase their percentage and get it back to 60% or 50% or whatever it is, which should produce some buying. That could be part of what we've seen in the last week or so. The short answer is there's no way to know for sure who is doing that buying. That's just an assumption. And number 2, I'm hearing there's more flexibility. So it might not necessarily be as clear-cut as it has been historically. Question number 3 was asking about, what was this? Yields. Comparing the 3-month Treasury bill, $UST3M, with another symbol, $IRX. Oh, I see. And why are these two different? Yeah, so here's the story, right? So this is looking at the 3-month Treasury yield, and sorry, it looks all crazy. It's because it's gone right to 0, and so it's kind of making the chart look pretty crazy here. But this is looking at 3-month yields. The other symbol you showed me was $IRX. So you're right; these are very similar. The second one, though, the IRX, we get it intraday because it's coming from the CBOE, the Chicago Board Options Exchange, and this is actually based on the options on the Treasury yield, right? So, or the Treasury bond. So they are telling you a similar thing, and they're going to map pretty closely. It's getting a little weird, though, because the IRX has actually gone below 0, while the 3-month yield in a lot of ways has not, especially intraday. So it's going to become a little bit disconnected right about now, which is what you're sort of asking at. So yes, I think directionally you can use the $IRX as a way of getting intraday movements in this particular thing. It should match pretty well with what you're seeing from the 3-month Treasury bill, which is the other ticker. They are not going to map 100%, and part of that is because they are closely related, but two different markets. One looking at bonds and one looking at the options on those bonds. But the second thing is just based on the movements being around 0. Next question: can you explain the impact that this market turmoil has on the technical indicators and their effectiveness? Can we still rely on them? Great question. 5 years from now, can you use the current data we're seeing, or will it just be considered? Will we consider that period as an outlier? That's such a great question. And my short answer is, I would argue in this sort of environment, when the market is driven by fear, it's driven by the emotional reactions, all this stuff that we're seeing and hearing, I would argue technical analysis is more effective than ever. When things are sort of straight and narrow, all is well, market's sort of churning higher, technical analysis has value, but we're not adding a ton because the volatility is not there. Increased volatility to a technician means increased opportunity. Volatility is opportunity. And so the fact that we've had severe movements just means we have to remember that periods are like this, and we have to look at our technical indicators through that lens. What I would tell you about it being different is what you cannot do is look to the left on this chart and compare some of these periods like from mid-2019 and make a one-in-one comparison to what that means for right now. I would be looking a lot more to historical bear market phases, late 2000s, 2000 to 2001, 2002, relative to where we're at now, and that's going to serve you much better. That is our Final Bar Mailbag for a Tuesday afternoon. We're going to take a quick commercial break. We'll be back with Mark Newton from Newton Advisors. Hello, everyone. Welcome back to the show. This is your host, Dave Keller at StockCharts.com. Please keep your questions and your feedback coming to us. We'd love to answer your question on our next mailbag segment, probably Friday of this week. So just shoot us an email, thefinalbar@StockCharts.com. That's the best way to get your questions in front of us. And there's so many questions that arise in this environment. So please let us help you make some better decisions. I want to get on to my guest, Mark Newton. Mark's from Newton Advisors. I've known Mark for a number of years. I feel like we first met when Mark, when you were with Morgan Stanley in New York a couple of years ago, I want to say, right?
Correct. That's right. I visited you up near Infidelity, I believe, during my travels.
There you go. So it's great to have you on the show. We've had you on before, and of course, always value what you're seeing. The first chart you sent us is really, I think, speaking to sort of that traditional leadership, the FANG trade. What is this telling you coming, during this bear market to little bull run phase here?
Yeah, so I think it's interesting, Dave, that we're still seeing quite a bit of strength out of technology, over the last few weeks. A number of these different stocks that make up the so-called FANG index, and this is shown by just the NY FANG, which is really 10 of the most highly traded and most recognized growth names within technology and consumer discretionary. And so, names like Amazon and Netflix, both of those have thus far retraced far more than the regular S&P or the NASDAQ cap from the lows. And I think it's just really interesting that we're still seeing a lot of strength out of this group. And until that really ends, that is keeping a little bit of a lid underneath this recent rally. A lot of people are discussing, well, we need to test the lows. And, I don't necessarily disagree there. But for now, you see that today's move really is extending above the highs that we've seen in the last few days and still indicates this might have some further upside in the days ahead as we enter the new quarter.
It's amazing how that basket of stocks and overall has served as leadership in the bull phase, but also the bear phase, I feel like, right?
Yeah, I mean, technology is actually positive over the last 6 months. It's the only one of the major groups that's still showing, positive trend, in performance. So, certainly a very violent move to the downside, as we all know and have experienced. But, as you see based on this chart, we really held where we needed to, right down near 2,500. And so I'm thinking this goes from 30, 34 and, potentially tests the end of that first wave down, which is near 31.73. So it's about another 5% up above from where we are. And that should be a decent area to consider if one would want to fade that trend. But it's just important to note that while, the last couple of weeks have proven a little more defensive, that yet we have still shown, strength within technology. Technology was still the top performer for the first quarter, so important to recognize.
Now, chart number 2 is switching gears a little bit more to the defensive side of the ledger in terms of utilities. What is this telling you?
So utilities relative to the S&P for the first time really in the last 10 years has really broken out above this downtrend since 2009. And so, one can look at momentum underneath or just look at basically the price action of the XLU, but we did manage to spike up above those prior peaks that were seen back in 2019 and also the latter part of 2018. So we have consolidated a bit. Utilities were actually quite weak today with the REITs to end the quarter. But overall, they have been, both the utilities and the REITs have been some of the strongest groups over the last week and also year to date. And so, my thinking is that we are starting a new intermediate term bull trend higher in some of these defensive groups, which would make sense given the overall market weakness and momentum being weak, and also with rates given as low as they are. So that makes sense from a couple of different angles. So one would always want to keep track of longer term relative charts of how the different groups are performing versus the S&P.
Now, your last chart is looking at the consumer sector and sectors, and I love this comparison of discretionary to staples. And I'm seeing a breakdown here. What is this showing you?
Yeah, so it's important to understand the components first of all. So this is the RCD versus the RHS, and both of those are Invesco equal weighted ETFs. One is the consumer discretionary modeled versus the equal weight consumer staples. And so interestingly enough, this actually did peak out back in the early part of 2018, along with many of the other world indices that peaked out during that time, has actually fallen ever since. So, many people look at discretionary as being, XLY and it's outperforming, or at least had into February. But what many people, what's interesting for me to do studies on is really when you look at these equal weighted baskets, it really puts things in perspective and shows that this actually has been weakening over the last couple of years. And so when you strip out the Amazons and the Home Depots, discretionary still is very much an underperformer over the last 2 years. And just recently, as this chart shows, we've actually broken a very long-term, if you want to call it uptrend, since 2009. And so we've undercut the lows in 2016. I view that as being very much a negative, and would mean that one would really want to favor staples on an intermediate term basis, which makes a lot of sense, with many of these companies providing things that are helping consumers during this time of the COVID-19 spread.
These are three great charts, Mark, and we've got about 30 seconds left. So I'd love to just ask you one question, a little off script. You've been through a couple of these bear cycles now, as have I. For someone this is their first experience going through this sort of environment, any brief words of wisdom you would have for them in terms of how to manage this sort of volatility, this sort of movement here?
Well, as you said, volatility is really important. It's important to just be very well diversified, not make a rush to pick the bottom based on factors that maybe have been important in recent years. During bull markets, a lot of people look at things like, oversold conditions and, sentiment being pessimistic and saying this is a reason to buy. But the bottom line is when we've seen one of the fastest declines on record, down 30% from all-time highs, it really opens up a new toolkit, and we have seen some pretty major intermediate term trend damage done. So one needs to be very tactical in terms of how you approach markets, but also, keep in mind that intermediate term trends have turned down. And so really any bounce that we're trying to play here likely, does prove short-lived, and it's not something to really bet the ranch on only because markets are down as much as they are.
Mark Newton from Newton Advisors, thank you so much for coming on the show. Really appreciate it.
My pleasure, Dave. Thanks for having me.
Okay, now we need to move right into the 3 and 3. 3 charts in 3 minutes. Here we go. Chart number 1 is the 10-year Treasury note yield $TNX. So yields coming down. And again, I would always remind people, when people speculate about bond prices, when I've published something about the TLT and talk about bond prices, I always get pushback on, well, hold on, how low could yields go? And my answer is yields can go lower than you think, and bond prices can appreciate, bond yields can go down. This doesn't reflect today's move just yet, but I wouldn't be surprised overall if we see continued fluctuation in the TNX and the 10-year yield. And again, as a reminder, it can go a lot lower than we've been so far. Chart number 2 is commodity prices. So, commodities came down again today. And again, today sort of felt like everything was down, really. And there were fluctuations midday, but by the close, we had a lot more differentiation in terms of, or I guess, an arrival of all of them and more on the bearish phase than bullish phase. And commodities certainly drove the way down as well, with something like gold down over 3%. So the GSG, which is one of the commodity ETFs that I follow, sort of looks a lot like that dead cat bounce that we've talked about for equities as well, right? A huge move down, a parabolic move down to last week, a nice rally very quickly to 10. And since then, it's now completely rolled over. And I have a feeling based on the charts I'm looking at that I think equities are soon to follow with that sort of downward move. Chart number 3 for our 3 and 3 is looking at the advancers and decliners. We talked last week about the Zweig breadth thrust signal, which is based on advancers and decliners. I thought it was interesting to note in early March, we had a ton of 90% down days, where over 90% of NYSE names were down on the day. Last week, we switched and had a 90% up day, which was an interesting kind of nice jump. It was that first up move after the market had broken below 2,200. Since then, we've sort of petered out. And if you look, we're having less and less of advancers on these up days. And today we had less than half of stocks going up on the day. Most of them were actually down. And I think looking at this as an illustration of breadth could be a really interesting way of watching this next couple days, next couple weeks, to see if we do continue sort of this rotation lower, follow along with the sell-off that we've seen in commodities. Ladies and gentlemen, that's our show for today, a Tuesday afternoon. Ending the first quarter here in March. Thanks so much for joining us every weekday after the close for the Final Bar. I want to encourage you to send your questions and your feedback to us. The Final Bar at StockCharts.com is the way to do it. Don't forget to check out our special called The Pitch tomorrow, where we look at some stock ideas given this environment. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.